How much money do you think you could lose if your bank failed tomorrow? Not from fraud, not from theft, legally, by government order, with full approval from regulators who promise they're protecting the system. In March 2013, people in Cyprus went to sleep as bank customers and woke up as bank creditors. 47.5% of deposits over 100,000 euros simply vanished overnight. Not stolen, seized, converted to worthless bank shares under a mechanism called bail-in. The people affected weren't criminals. They were business owners, retirees, anyone who had saved more than the insured limit. And it was completely legal. The mechanism that made this possible isn't unique to Cyprus. It exists in Europe under the Bank Recovery and Resolution Directive. It exists in America under Dodd-Frank. And as we move into 2026, with $9 trillion in U.S. debt set to roll over at higher rates and banks facing their own maturity walls, the conditions that triggered Cyprus are forming again, larger, faster, in the world's reserve currency. This video is about one idea. The bail-in mechanism isn't a conspiracy theory or a future possibility. It's codified law in every major financial system, waiting to be activated when the math stops working. And the math is about to stop working. I'm the debt archivist. My job is to dig through old files to find the patterns your news never explains. Today we're opening the file on bank bail-ins, specifically the Cyprus 2013 case and why the same legal framework exists everywhere now, pointing toward 2026 as the next pressure point. This isn't speculation. It's what happens when debt service costs exceed what systems can bear, and governments decide depositors are cheaper than taxpayers. Let's start with what actually happened in Cyprus, not the sanitized version. The 3 a.m. decisions that turned bank accounts into collateral. Cyprus 2013. The weekend your money became bank capital. In early 2013, Cyprus looked stable on paper. A European Union member since 2004. Eurozone since 2008. Banks offering attractive interest rates, low corporate taxes, a financial hub. Beneath the surface, the system was dying. Cypriot banks had grown to 7 times the size of the national economy. They'd loaded up on Greek government bonds, chasing yield. When Greece restructured its debt in 2012 with a haircut exceeding 50%, Cypriot banks took losses exceeding 4 billion euros. 22% of Cyprus' GDP wiped out in one restructuring. The 2 largest banks, Laiki Bank and Bank of Cyprus, were insolvent. The government couldn't bail them out. Public debt was already 80% of GDP. Bond markets had locked Cyprus out. Yields on government bonds exceeded 12%. The country needed external help. On June 25, 2012, Cyprus formally requested a bailout from the European Union, European Central Bank, and International Monetary Fund, the Troika. Negotiations dragged for 9 months. Germany's parliament, tired of funding Southern Europe, insisted creditors share the pain, not taxpayers. Creditors. Friday, March 15, 2013. Banks closed as normal for the weekend. Cypriots had no warning of what was coming. Saturday morning, March 16th. The Eurogroup announced the terms. Cyprus would receive 10 billion euros. In exchange, the country would impose a one-time levy on all bank deposits, 9.9% on deposits exceeding 100,000 euros, 6.75% on deposits below that threshold. Everyone would pay. Even insured depositors. The announcement triggered panic. ATMs drained. People tried to wire money abroad. But it was Saturday. Banks were closed. Capital couldn't escape. Sunday, March 17th, protesters surrounded government buildings. The newly elected president, Nikos Anastasiades, faced a choice: accept the levy or let the country collapse. His own party called it bank robbery. Monday, the banks stayed closed. Then Tuesday, the government needed time. Tuesday, March 19th, Parliament voted 56 seats, not a single vote in favor. The levy was rejected, the deal collapsed. But Cyprus still needed money. The ECB threatened to cut off emergency liquidity assistance. Without ECB support, the banks would fail immediately. Cyprus had no choice. Negotiations resumed. A new deal emerged, harsher. Monday, March 25th. The revised terms, Laiki Bank would be wound down completely. Deposits under 100,000 euros would transfer to Bank of Cyprus and remain protected. Deposits above 100,000 euros at Laiki would be wiped out, converted to equity in a bad bank that would never have value. At Bank of Cyprus, deposits under 100,000 euros were protected, but deposits above that threshold would be frozen, then confiscated. Initially, 37.5%. After independent valuation, the haircut increased to 47.5%. Nearly half of uninsured deposits converted to bank shares in a bank that had just failed, shares that would take years to become tradable and would ultimately trade at a fraction of face value. This wasn't a proposal, it was a done deal. The government implemented it under emergency powers while banks remained closed. Thursday, March 28th, banks reopened. Capital controls were in place, withdrawal limits of 300 euros per day. No checks could be cashed. Transfers abroad required central bank approval and proof of commercial necessity. Students studying overseas could receive only 10,000 euros per term from family. Armed guards stood outside bank branches. Police monitored airports. Anyone leaving Cyprus could carry only 1,000 euros in cash. The free movement of capital, one of the European Union's 4 fundamental freedoms, suspended indefinitely. Depositors discovered their money had become bank capital. Business owners who kept operating funds above the insured limit lost half overnight. Retirees with lifetime savings in term deposits couldn't withdraw. Their deposits were frozen pending conversion to equity. The European Commission called it necessary. The IMF called it a template. The Eurogroup president, Jeroen Dijsselbloem, said publicly that the Cyprus model could be used elsewhere if needed. Savers, not taxpayers, would fund future bank failures. This wasn't a bank run. This was a bank resolution, and it was completely legal. The mechanism had a name, bail-in, and it had just been tested successfully on live depositors in a developed economy. Bail-in versus bailout. Who pays? When banks fail for decades, the pattern was simple. Banks failed. Governments bailed them out. Taxpayers funded the rescue, and the system stayed intact. 2008 broke that pattern. Lehman Brothers collapsed. Credit froze. Governments pumped trillions into failing banks. In the United States alone, the Troubled Asset Relief Program authorized $700 billion in bailouts. The final costs, including Federal Reserve emergency lending, exceeded $16 trillion. In Europe, governments nationalized banks. Ireland guaranteed all bank deposits and senior debt. The guarantee bankrupted the government. Ireland's debt-to-GDP ratio exploded from 25% in 2007 to over 100% by 2012. The public backlash was severe. People watching their homes foreclose while banks got rescued turned against the entire system. Politicians promised it would never happen again. No more taxpayer-funded bailouts. But banks still needed a way to survive failure. Enter the bail-in. The concept is simple. Instead of taxpayers providing capital from outside the bank, creditors provide capital from inside the bank. Shareholders get wiped out first, then bondholders, then uninsured depositors. Each class absorbs losses until the bank is recapitalized. In theory, this creates market discipline. Creditors monitor bank risk. They demand higher returns for holding debt in risky banks. Banks that take excessive risk pay more to borrow. The system self-regulates. In practice, it means your deposit becomes collateral. Think of it this way. When you deposit money, you're not storing cash in a vault. You're lending to the bank. The bank owes you. That makes you a creditor. And under bail-in rules, creditors fund recapitalization. The difference between bail-in and bailout isn't just who pays, it's speed and scope. Bailouts take time, governments must pass legislation, taxpayers see the cost, the political process creates delay and debate. Some banks don't get rescued. Lehman failed because the government decided not to bail it out. Bail-ins happen over a weekend. Regulators invoke emergency powers. Deposits freeze. Conversions occur. By Monday morning, the bank is recapitalized. Depositors can't vote, can't appeal, can't transfer funds to safety. The resolution happens before anyone can react. The speed is the point. Bank runs happen when depositors sense danger and rush to withdraw. If you freeze deposits first and convert them to equity second, the run never happens. The bank stays liquid because the creditors can't leave. From a systemic stability perspective, bail-ins are brilliant. From a property rights perspective, they're confiscation with legal cover. Here's the comparison. Imagine two banks. Both fail on Friday. Bank A gets a taxpayer bailout. The government injects capital. Depositors keep their money. Taxpayers fund the rescue through higher taxes or increased debt. Politicians face voter anger. The The process takes weeks or months to arrange. The bank might fail anyway if the politics don't work. Bank B gets a bail-in. Regulators invoke resolution powers. The bank closes Friday. Deposits freeze. Over the weekend, regulators convert 40% of uninsured deposits to equity. Monday morning, the bank reopens, recapitalized. Depositors who had $100,000 now have $60,000 in cash and $40,000 in shares worth of maybe $20,000 in a distressed market. Total loss? $80,000. No taxpayer money used, no political debate, clean, fast, final. The Financial Stability Board, which includes G20 finance ministers and central bankers, endorsed bail-ins in 2011. The message to governments was clear. Next time banks fail, don't use taxpayer money. Use creditor money. It's already inside the bank. Cyprus proved the model worked. Depositors didn't riot. The banking system survived, the economy eventually recovered, and most importantly, no major international bank lost confidence in the system. The template was set. Now it needed to become law everywhere. The legal framework, BRRD and Dodd-Frank. In 2014, the European Union adopted the Bank Recovery and Resolution Directive, BRRD. Every member state had until January 1, 2016, to transpose it into national law. The directive gives resolution authorities sweeping powers. They can write down equity, convert bonds to shares, seize deposits, split banks into good and bad banks, all without shareholder or depositor consent. Article 55 is the key provision. It requires banks to include contractual recognition of bail-in any agreement governed by non-EU law. If a European bank enters a contract with an American company, that contract must explicitly state that European regulators can bail in the bank's liabilities, and the American company agrees to this in advance. This isn't theoretical. Every major bank in Europe now includes bail-in clauses in loan agreements, derivative contracts, and deposit terms. The clauses state clearly, we may be bailed in by regulators. You acknowledge this, you accept it, you waive your right to challenge it. The BRRD excludes certain deposits from bail-in. Deposits under 100,000 euros are protected, matching the EU Deposit Insurance Guarantee. Deposits used for payment services, like payroll accounts, have some protection, but deposits above the insured limit are explicitly bail-in eligible. The stated goal is to prevent taxpayer bailouts. The real effect is to make deposits legally seizable. In the United States, the framework is different, but the result is similar. The Dodd-Frank Wall Street Reform and Consumer Protection Act passed in 2010. 848 pages of legislation requiring regulators to create 243 rules. One of those rules is the Orderly Liquidation Authority. Title II of Dodd-Frank gives the Federal Deposit Insurance Corporation power to resolve failing banks that pose systemic risk. The FDIC can seize a bank, wipe out shareholders, impose losses on creditors, and continue operations, all without a bankruptcy judge. The law states clearly, protect the American taxpayer by ending bailouts, impose losses on common and preferred stockholders, debt holders, and other unsecured creditors. Other unsecured creditors. That's the language that matters. When you deposit money in a bank, you become an unsecured creditor. The bank owes you. If the bank fails, you're in line with other creditors. Your deposit becomes a claim in the resolution process. The FDIC insures deposits up to $250,000 per depositor, per bank, per ownership category. Anything above that limit is uninsured. And uninsured means bail-in eligible. Dodd-Frank does something else important. It exempts derivatives. If a bank fails, derivative counterparties get first claim on assets. They can demand collateral. They have priority over depositors. This matters because the largest banks hold trillions in derivative exposure. When those counterparties get paid first, there's less capital available for depositors. In 2014, the Federal Reserve added another rule, the Total Loss Absorbing Capacity Requirement, TLAC. It requires the 8 largest U.S. banks to hold enough loss-absorbing instruments to withstand failure without taxpayer support. These instruments include long-term debt that converts to equity in a crisis. TLAC was fully phased in by 2022. The largest banks now hold instruments specifically designed to absorb losses during resolution. And where does the loss absorption happen? By converting debt to equity, by bailing in creditors. Both systems, European and American, reached the same conclusion. The next bank crisis won't be solved with taxpayer money. It will be solved with creditor money, and depositors are creditors. The laws are in place, the mechanisms are tested, the precedent exists. The only question is when the pressure reaches the breaking point again, and 2026 looks like the answer. Why 2026? Debt maturity, deficits, and the fiscal vice. The timing isn't arbitrary. Multiple pressures are converging in 2026 that create conditions similar to Cyprus in 2013. Debt rolling over at higher rates, bank funding under stress, fiscal deficits unsustainable. The math stops working. Start with government debt. The United States has $36 trillion in public debt. About $9 trillion is scheduled to mature in the 12 months ending March 2026, 1/3 of all outstanding debt rolling over in a single year. Most of that debt was issued during the post-COVID period when interest rates were near zero, Treasury bills at 0%. 10-year notes below 1.4%, the government borrowed at the cheapest rates in history. Now that debt needs to be refinanced. Current 10-year Treasury rates hover around 4%. The Congressional Budget Office projects rates will remain between 3.6 and 4.1% through 2034. Every percentage point increase in interest rates on $9 trillion of debt means $90 billion per year in additional interest payments. If the average rate on refinanced debt increases by 2 points, which is conservative given where rates were versus where they are now, that's $180 billion in new annual debt service costs. The United States already pays over $890 billion in net interest on the debt as of 2024. That's 3.1% of GDP. By 2026, net interest costs are projected to exceed $1 trillion annually. That will be the largest single line item in the federal budget, larger than defense, larger than Social Security, just interest. Here's the problem. When interest costs exceed $1 trillion and deficits run nearly $2 trillion annually, the government must borrow enormous amounts just to pay interest on previous borrowing. This is the debt spiral. Borrowing to service debt. And who buys the debt? Not foreign holders. Foreign ownership of U.S. Treasuries has declined from nearly 50% to 30% of total outstanding. The Federal Reserve stopped buying during quantitative tightening. That leaves domestic private investors, primarily commercial banks, as the marginal buyer. Banks are holding more treasuries than ever, but banks also face their own pressures. The high-yield corporate bond market has a maturity wall, $500 billion in high-yield debt issued during the COVID period at ultra-low rates matures between 2024 and 2026. That debt needs to be refinanced at rates 3 to 4 percentage points higher. Many issuers can't afford the new rates. Default rates are rising. Moody's projects high-yield defaults will peak near 6% in 2025. Defaults mean losses for banks holding the debt. Regional banks face additional stress. They hold significant commercial real estate exposure. Office buildings with high vacancy rates. Retail properties. Struggling as e-commerce grows. Multifamily properties facing rent pressure as housing affordability declines. Commercial property values have dropped 30% since 2020. Non-performing loans at U.S. banks are rising, not crisis levels yet, but rising. And rising non-performing loans mean banks must increase loan loss reserves. Increasing reserves means reducing capital. Reducing capital means less cushion to absorb losses. Now add the fiscal pressure. The U.S. deficit was $1.8 trillion in 2024 during a period of economic growth and near full employment. Historically, deficits that size only occur during recessions. Running a 6 to 7% of GDP deficit at full employment means there's no fiscal cushion if the economy slows. If a recession hits in 2025 or 2026, which Goldman Sachs currently estimates at 30% probability, roughly double the historical average, the deficit will explode. Automatic stabilizers kick in, tax revenue falls, unemployment benefits rise, discretionary spending increases. A deficit that's already $1.8 trillion could easily reach $3 trillion in a recession. The government must fund that deficit by issuing more debt. But who buys it? Foreign holders are reducing exposure. The Fed isn't buying. That leaves private domestic buyers, primarily banks. Banks that are already holding record amounts of treasuries. Banks facing their own capital pressures. This is the vice. The government needs banks to buy debt. Banks need government backing to survive. When both need each other simultaneously, the weakest link breaks. In Cyprus, the weakest link was depositors. In 2026, with U.S. banks holding deposits exceeding $10 trillion, depositors are the largest pool of accessible capital inside the system. The FDIC Deposit Insurance Fund holds roughly $120 billion. The fund is designed to handle normal bank failures, small banks, regional failures, not systemic crises. If multiple large banks face capital shortfalls simultaneously, $120 billion is insufficient. The backup plan is bail-in. It's already in the law. The mechanisms exist. The precedent is set, and the fiscal pressure is building. The psychology? Why regulators choose. Bail-in understanding the math is one thing. Understanding the mindset is another. Why would regulators choose to seize deposits instead of arranging bailouts? The answer is political and psychological. First, the political reality. Taxpayer bailouts are politically toxic. After 2008, the phrase, "too big to fail," became a rallying cry against the financial system. Politicians promised never again. They passed laws prohibiting it. They told voters that next time Wall Street would pay, not Main Street. That promise puts regulators in a bind. When a systemic bank faces failure, the regulator has three options: let it fail and risk contagion, bail it out and face political destruction, or bail it in and claim you're following the law. Bail-in lets regulators claim they protected taxpayers. They didn't use public funds. They imposed losses on creditors, just like the law requires. The fact that creditors include small business owners and retirees is unfortunate, but legal. Second, the psychological framing. Regulators genuinely believe bail-ins promote financial stability. The reasoning goes like this: if depositors know their money is at risk, they'll monitor banks more carefully. They'll choose safer banks. They'll avoid institutions taking excessive risk. Market discipline will prevent failures. This logic has a fatal flaw. Most depositors can't actually assess bank risk. Small business owners don't read bank balance sheets. Retirees don't analyze capital ratios. They trust that insured means protected and assume anything in a bank is safe. When depositors discover that uninsured means seizable, the result isn't market discipline. It's a run. People try to withdraw anything above the insured limit immediately. This creates the instability regulators claim to prevent. The solution? Move fast, freeze deposits before people can react. Implement the bail-in over a weekend. By Monday, it's done. Confidence can be managed after the fact. Third, the institutional imperative. Central banks and regulators exist to preserve the financial system, not individual banks. The system. If a bank must fail to protect the system, the bank fails. If deposits must be seized to recapitalize the bank, deposits are seized. The system takes priority. This creates a moral hazard in reverse. Banks know that in a true crisis, regulators will bail in depositors to save the system. This removes the incentive to maintain excess capital. Why hold more capital than required if you know depositors will provide it when needed? Finally, there's the confidence game. Banking is fundamentally about confidence. People deposit money because they trust it's safe. If that trust breaks, banks fail instantly. Regulators will do anything to prevent a confidence break, including seizing deposits preemptively to show strength. In Cyprus, regulators waited until the last possible moment. Banks were days from collapse. The ECB was about to cut off liquidity. The resolution had to happen immediately or the entire system failed. In the United States, regulators would likely act earlier. They monitor capital ratios constantly. They know when banks approach crisis levels. They would invoke resolution authority before failure is public. Banks would close Friday, reopen Monday, recapitalized. Depositors wouldn't have time to react. The psychology is clear. Regulators believe bail-ins are necessary, legal, and systemically stabilizing. They view depositor losses as acceptable collateral damage in service of system preservation. And they have the legal authority to act without depositor consent. The question isn't if they'll use bail-in powers, it's when the conditions force them to act. What protected some Cypriots? The lesson hidden in the data. Not everyone in Cyprus lost money. That's the detail most accounts skip. While 47.5% of uninsured deposits at Bank of Cyprus were converted to equity and depositors at Laiki Bank lost everything above 100,000 euros, some people kept their money intact. What did they do? First, the obvious. Anyone with deposits under 100,000 euros was fully protected. The EU deposit guarantee held. These depositors didn't lose a euro. This created an immediate lesson: keep money below insurance limits. Spread deposits across multiple banks if necessary. Don't keep everything in one institution. Second, some people withdrew cash before banks closed. The government announced the initial levy proposal on Saturday, March 16th. Banks were already closed, but ATMs worked. The withdrawal limit was 400 euros. People who checked their accounts Saturday morning and withdrew the maximum kept that cash. It wasn't much, but it was something. Third, some moved money to branches of Cypriot banks located outside Cyprus. The levy applied only to deposits held in Cyprus. If you had an account at a Cypriot bank's branch in Greece or the UK, that deposit was protected. The number of people who knew this and acted on it was small, but those who did preserved their capital. Fourth, and most importantly, some people held physical assets instead of bank deposits: gold, cash, real estate. These assets weren't bail-in eligible. You can't convert gold to bank equity. You can't seize cash that's in a safe. Property ownership doesn't change because a bank failed. In the months following the Cyprus bail-in, researchers tracked what happened to money holdings. Bank deposits by domestic residents dropped 25% over 6 months. This wasn't just the bail-in itself, it was people pulling money out after the fact. At the same time, net cash issuance tripled. People were converting deposits to physical euros and holding cash at home. The pattern was clear. Trust in the banking system collapsed. Even people who didn't lose money in the bail-in decided banks weren't safe. They wanted physical control of their assets. This behavior persisted. Years later, Cypriots held more cash relative to income than residents of other EU countries. The psychological scar remained. If it happened once, it could happen again. The capital controls meant to prevent bank runs stayed in place for over 2 years. The government lifted restrictions in phases. First, allowing larger withdrawals, then permitting domestic transfers, then slowly relaxing limits on international transfers. By April 2015, most controls were gone. But the damage to confidence was permanent. Here's what this teaches. When deposits become seizable, the rational response is to hold assets that can't be seized. Bank deposits are convenient, but vulnerable. Cash is less convenient, but controllable. Precious metals are harder to transact, but completely outside the banking system. Real estate can't be converted to bank equity. The people who preserved capital in Cyprus either stayed below insurance limits, held physical assets, or moved money to jurisdictions outside the bail-in zone. The people who lost were those who assumed large deposits in a single bank were safe because Cyprus was part of the EU and the Eurozone. The assumption that membership in a major financial system guarantees safety is the mistake. In crisis, legal protections change fast. What was guaranteed on Friday becomes bail-in eligible by Monday. The only protection is staying below guaranteed limits or holding assets outside the system entirely. So what? The framework you need. Now, you don't control government debt loads. You don't control bank capital ratios. You don't control when regulators invoke bail-in powers, but you do control where you keep money. Understanding the bail-in framework changes how you think about deposits. A bank account isn't a storage vault. It's an unsecured loan to the institution. The bank owes you. And in resolution, creditors fund recapitalization. This doesn't mean banks will fail tomorrow. Most won't. The U.S. banking system is well capitalized by historical standards. FDIC deposit insurance is real. The Deposit Insurance Fund is healthy. For amounts under $250,000 per depositor, per bank, per ownership category, you're protected. The risk is in amounts above insurance limits. Business operating accounts, real estate transaction accounts, investment accounts waiting for deployment, retirement savings that exceed limits. If you have $250,000 in one bank, you're covered. If you have $500,000 in one bank, half is at risk, not guaranteed to be seized, but legally seizable if the bank fails and regulators invoke bail-in powers. The framework suggests simple steps. First, know the limit. $250,000 per depositor, per bank, per ownership category. Individual accounts, joint accounts, certain retirement accounts, and trust accounts each have separate coverage. You can structure accounts to increase total insured coverage. Second, spread deposits across multiple institutions. $500,000 in one bank means $250,000 at risk. $250,000 in each of two banks means full coverage. This requires more management, multiple relationships, multiple statements, but it reduces seizure risk. Third, understand that bail-in happens fast. Cyprus banks closed Friday, reopened the following Thursday with deposits converted. You won't have time to react. If your bank is in trouble by the time you know the resolution is complete, this means preventive action is the only option. Fourth, hold some physical assets outside the banking system, not all your money, but enough that if bail-in occurs, you have liquidity that isn't frozen. Cash at home, precious metals, something that doesn't require bank access to use. Fifth, recognize that major economic stress creates conditions where bail-in becomes likely. 2026 has multiple pressure points converging: massive debt rollover, rising interest costs, fiscal deficits at levels historically associated with recession. If economic conditions deteriorate sharply, bank capital comes under pressure. This isn't panic, it's pattern recognition. The same conditions that triggered Cyprus are forming in larger systems. The same legal frameworks exist. The same regulatory mindset dominates. When math stops working, systems choose the path of least political resistance. Seizing uninsured deposits is legally cleaner and politically easier than taxpayer bailouts. The value in understanding this isn't paranoia. It's knowing the rules of the game. You're not a depositor in the sense you probably think. You're an unsecured creditor. And creditors in resolution systems provide capital, voluntarily or otherwise. The people who avoid losses or those who act before crisis is obvious. By the time CNN runs stories about bank failures, deposits are already frozen. By the time politicians debate solutions, bail-in is complete. The action window is before stress becomes visible, not after. You now know more about deposit seizure mechanisms than 99% of people. You understand that bail-in isn't theory, it's tested practice. You know it's codified in law across every major financial system. And you know the conditions that trigger it are forming as we move into 2026. That knowledge gives you a choice most people won't have. Act on it or ignore it, but don't claim surprise if the pattern repeats. The archive doesn't predict the future. It shows you the sequence we're already in. Cyprus 2013 wasn't an anomaly. It was a test run. The Financial Stability Board documented the results. Regulators studied what worked. Legislators codified the mechanisms. The template is ready. It's waiting for conditions that make implementation necessary. Those conditions are building. $9 trillion in U.S. debt rolling over at rates 3 to 4 points higher than original issuance. Interest costs exceeding $1 trillion annually. Deficits at wartime levels during peacetime. Banks holding record treasury exposure while facing their own credit pressures. The fiscal and financial vice tightening simultaneously. 2026 is when the maturity wall hits hardest. When refinancing costs spike most acutely. When the math of servicing debt at higher rates becomes undeniable. Whether this triggers bank stress that requires bail-in depends on variables we can't control. Recession timing, credit defaults, confidence shocks. But the framework exists specifically for moments when variables align badly. The people who preserved capital in Cyprus weren't smarter. They were prepared. They understood that guarantees change in crisis. They kept deposits below limits or held assets outside the system. When the weekend came that changed everything, they didn't lose. You have the same information now, the same framework, the same choice. Stay below insurance limits, spread deposits, hold physical assets. Understand that your bank account is an unsecured loan to an institution that, in crisis, will use your capital to survive. If you want more calm, no bullshit breakdowns of how debt, empires, and currencies really behave, subscribe to the Debt Archive. The files are open. The patterns are clear. The sequence we're in doesn't require prophecy, just attention. The next file drops soon.